This is John Llodra from New Harbor Financial Group for our weekly dose of data insight, really all for the purpose of hopefully helping you make sense out of these crazy markets at times and hopefully reduce your stress level and confusion. It is Thursday, the 25th of January, 2024. I'm glad to be with you here today. Quickly, I'll run down what I'll cover here today. I want to continue a little bit of a thread that my partner Mike Preston started last week, really to give our clients and viewers a little bit of a sense for some of the tools we use to kind of build our investment strategy. We don't have a black box. We have a very disciplined, data-driven process that takes in a lot of factors. So I'd like to give you some further glimpse into how we use these tools and our judgment to allocate and manage client investments. Of course, I would like to give a quick review of some market action. I'll cut to the punchline. This past week, the S&P 500 finally breached a new all-time high, took out the previous all-time high that was registered a little over 2 years ago on January 3rd of 2022. And then I'll talk a little bit about some of the interest rate noise going on in the markets. And so I'm glad you're with me here today, and I'll get right into it. So I thought I'd share a simple graphic to help illuminate some of the investment building blocks of our process. So let me do that. I'm going to share my screen here. This graphic is meant to be simple because our process is pretty simple. It's sophisticated, but simple at the same time. So if we start at the bottom, the base of our process here, and as the title of the video might have given away, we like to think of things in terms of offense and defense, and how fitting is it that we're just a little bit over 2 weeks away from the Super Bowl here in the football world here in the U.S. anyways, and I'm a little saddened that our beloved New England Patriots here in New England aren't here this year, and they certainly haven't been for a while, but it should be exciting nonetheless. Anyways, when we think about investing in markets, and not just the stock market, but any market, bonds, commodities, whatever, we ask ourselves, are we on offense or in defense? Is the climate conducive to advancing the ball down the field and scoring points, or is it inducive of setting you back and taking points away or yardage away, for that matter? And like with most things in life, it's not a black and white thing. We think of offense and defense as a matter of degree. And some of the things that we use to kind of gauge this offense or defense posture, certainly fundamentals matter on the longer term anyways. And one of the most critical fundamentals is valuations. Quite simply, if you pay too dearly a price for something, your subsequent returns over timeframes that matter, say a decade, is very likely to be poor. And history will bear that out very clearly. Likewise, if you invest when valuations are low, that's conducive to really solid, durable, long-term gains. So high valuations suggest more of a defense posture. Low valuations suggest prudent investment in more of a stock posture or an offensive posture. And again, there's a matter of degrees here. Some of the great work of folks like GMO, Jeremy Grantham's firm GMO. Vanguard just put out a paper a month or two ago. I did a highlight of that in a timely take here on our YouTube channel. You might want to go back and take a look at that. But even Vanguard, one of the most vocal proponents of passive index investing, has raised some concerns about when valuations of different asset classes, let's pick on stocks, get too rich, it makes sense to scale back stock exposure. So that's what we're talking about there. But we also look at shorter term technical factors, and I'll get into some of these in a bit, to gauge whether we're on offense and defense. Continuing the football analogy, again, the next level is, okay, we've decided, what degree of offense and defense. You might think about that as a simple pie chart. How much stocks versus how much bonds, how much cash, how much commodities and things like that. Once we figure out the pie chart, and there's no perfect science, it's a matter of judgment and probabilities and assessments. The question, like any good football coach, would be, okay, if our offensive team is on the field, what players do we put on the field? Do we put our utility running backs? Do we put our deep bomb wide receivers? So this is akin to what Mike touched upon in last week's video. We use tools like relative strength to systematically select the geographies, sectors, you name it, and even different asset classes to populate these segments of the pie chart. So if we deem, for example, 30% in equities is the right place to be from an offense and defensive posture, well, what do we want to populate that 30% slice with? Do we want to be in energy stocks, which have been very weak of late, or do we want to be in things like industrials and insurance, like we're in right now, that have been very strong? We use our tools like relative strength, and Mike talked about that last week, to pick the players, if you will, the ones that are appropriate for the environment, but also are on a hot streak. You could think about this as racehorses. They go in streaks of winnings and losings, and sometimes it has to do with their biology, their physicality. You can think about produce in the grocery store. Not all forms of produce are in their prime season at all times of the year. So we use these tools, relative strength, to pick amongst the different options in each of the kind of pie chart segments, if you will. And then the final nuance here is the top part here. What plays do we run? Any good football fan or coach would know you're going to run a different kind of play if your back is against your own goal line. You're going to run a very conservative play versus if you're knocking on your opponent's goal line. You have the leeway to run a little bit more risky play, perhaps. So, and that's really gets into for example, our hedging strategies. We can have an allocation to equities, but in certain environments we may hedge that very tightly. So that's akin to kind of the plays that we run. So hopefully that construct and the analogy to football is one that makes sense to you. Obviously, there's a lot of detail here that is on our dashboard that we use in our process, and it's not a black box. It certainly demands and we think has benefited from some judgment and perspective that we bring to the table, synthesizing all these things. So I guess I want to get back to some of these tools. So I want to talk about valuations. So valuations are again not very good timing indicators in the short term, but they are great indicators for longer term investors. And I want to show a quick example here to make that point home. Okay, so here is an example of two scenarios of 15-year investment horizons. And this kind of looks at a hypothetical scenario where someone has a $1 million nest egg and they want to withdraw 5% of that each year. So 5% of $1 million is 50,000, and give themselves a raise for inflation, 2.5% a year, let's call it. This shows the stark difference between two kind of scenarios. One where, for example, in 1982, where the Shiller PE stock market valuation ratio was 7.18. That's a very low historical. That was the great time to be investing in stocks. In other words, great time to be largely on offense. Okay, and these were the actual returns that the S&P 500 saw in those years. And you can see because of that very low valuation and great subsequent returns, they averaged about 13.3% over that 15-year horizon through 1996. Even despite these increasing withdrawals, the ending value of the portfolio continued to basically grow quite substantially. So the $1 million ended up being almost $4 million, even despite those withdrawals. Now let's look at an opposite scenario. Let's look at the peak of the tech bubble in 2000, where the PE ratio was over 42. And because of that very high valuation, the markets suffered some very dramatically down years in the early years. And even in 2008, for example, which is just, we think, a continuation of the tech bubble, even though this was the housing bubble. I think it's a series of successive bubbles. But anyways, that 15-year horizon only averaged about 4.1%, even despite the great solid returns following each of these bubble collapses. And you can see the same kind of withdrawal scenario in this simple example. Not only would have not grown the nest egg, but it would actually have depleted. And that the average return over that period of time is 4.1%. So clearly, valuation does matter on the long term, anyways, even if in the short term it doesn't. And this is just one example of that. The next slide I want to get to is just kind of, we'll skip this one. This is a quick snapshot of the Shiller PE. All to say is where we are right now at almost 33. It exceeds virtually every point in history with the exception of the flare up here in 2021 after COVID and the tech bubble. And even if you compare the tech bubble and now, if you adjust for things like margins and things like that, we're actually right on par with that. We're on par with the very peak of the Great Depression, precursor to the Great Depression, as well as the tech bubble. So the next one here, I just want to talk about some of the other non-fundamental indicators we use to kind of gauge offense versus defense. So first off, we'll look at things like overbought, oversold readings, relative strength, index, Bollinger Bands, things like that. I'm not going to go into great detail. I just want to, point I want to make here is we have a robust set of different kinds of indicators. And I would describe our approach as a weight of the evidence approach. In other words, imagine an analogy they oftentimes use of a jigsaw puzzle. What we're trying to do with various types of indicators is to start to put together a jigsaw puzzle as to what the future likely holds. And like a good jigsaw puzzle, you can kind of get a good sense for what the image is ultimately going to be, even if you don't have all the pieces in place. And the more pieces you have in place, the clearer the picture becomes. I contrast that with some kinds of approaches that others use, where they're simple, maybe indicate on-off switches, where they have one main indicator, call it relative strength or whatever, where they're flipping a light switch basically based upon one or a very narrow set of indicators. We think that is not really a robust long-term way to go. In fact, can lead to a lot of whipsaws, getting always chasing your tail, and frankly, a lot of turnover that from a tax standpoint can greatly diminish any gains that's likely to achieve. So we prefer a weight of the evidence approach. So we look at overbought, oversold indicators. We look at sentiment or contrarian type indicators, things like the Association of American Association of Individual Investors, the National Association of Active Investment Managers. In fact, I spelled that wrong. It should be NAAIM. The fund management surveys, put call ratios, things like that. These are things that when they get to one extreme, it kind of indicates doing the opposite, okay? You might even call magazine covers a tongue-in-cheek kind of contrarian indicator. When Barron's magazine or Newsweek is touting something, it's usually, or fear-mongering about something, it's usually a pretty good indicator to do the opposite. We look at trend and momentum indicators, chart breakouts, breakdowns, momentum, things like that. Breadth, how wide is the participation in the market? In last year, for much of last year, for example, we saw a very narrow market. It wasn't until the very end of the year that breadth widened out in the market. And related to that is things like uniformity, diversions. And then there are some kind of risk off, risk on kind of flashes, if you will, things like volatility, expansions in credit spreads, and whatnot. So, I hope that's helpful to just give you a glimpse of some of the things that we do. Those indicators are taken in concert, and again, some are kind of neutering others at times, but when many of these pieces all kind of fall in line to suggest a defensive posture, it strengthens the signal, if you will. Okay, so let's talk about the market quickly. So as I mentioned, this past week, the S&P finally breached a new all-time high. The prior high was January 3rd of 2022. We just took that out this past week. And so far, year to date, the S&P cap-weighted index is up about 2% through yesterday. If you look at small caps, small mid caps, the Russell 2000, that's actually down about 3% through yesterday. You look at the Mag 7 that we've talked about forever, the 7 stocks that you probably all know by heart by now. Those were up about 5% year to date through yesterday. I saw a stat a couple of days ago that about 52%, over half of the year to date so far return in the S&P was comprised of 2 stocks, Microsoft and NVIDIA. And you look at things like, again, I talked about small caps, they're not participating. So what we're seeing so far this year is a kind of a resumption of a very narrow market, very narrow in terms of sector leadership and very narrow in terms of the number of stocks participating. So it remains to be seen what that, as we've talked about in recent videos, even despite the tremendously overvalued stock market, the suite of technical indicators that we monitor in conjunction or in concert have suggested a bullish follow through, and that's exactly what we've had. And we've got about in the vicinity about 40% equity exposure right now. That's more than we had, say, for example, a year ago, and it's simply because our indicators beckoned us to do so. But of course, we do have defensive plays around those postures. We have robust hedging, so we're calling the plays that we think are appropriate for the environment, offensive, but with a very decidedly defensive tilt to them. I guess the one final thing I'd like to just talk about is interest rates. I'm going to share, basically in recent weeks, I've talked about the great standoff between the market and the Fed. The market in late last year telegraphed that, hey, we're almost certainly done hiking this phase of the rate cycle, and we could conceivably see maybe dropping interest rates to the tune of maybe 3 separate quarter percentage point drops in 2024. Well, the market totally took that and ran with it, and basically priced in probabilities of 7 or 8 declines in prices. So instead of about a 0.6, 0.7% rate drop expectation, the market at one point was pricing in 1.5, 2% rate drops in 2024, 7 or 8 drops. So I want to show you what in recent weeks, though, we've had some news reports that has kind of narrowed the divide there between the market and the Fed. So let me share a chart to show you what that looks like. And this is going to what's called the CME Fed Watch tool. Okay, so hopefully you can see this. And what this shows, so our current, I'm going to go to the January. So these are the different meeting dates. So we have a Fed meeting coming up at the end of January 31st. Okay, and right now the current target Fed funds rate is 5.25 to 5.5. That's where it's been since, I think, last July. They've stood pat at that level for the last half a year or so. Okay, and what this shows is the market's assumed probabilities from a month ago, a week ago, a day ago, and today. Okay, so what you can see, there wasn't much expectation of a drop in interest rates, which would be down to, for example, 5 and 5.25 at this January meeting. Where the divide really started to happen is in the March meetings and beyond. So for example, you can see a month ago, the market was pricing in about a 76% probability that the Fed would drop a 0.25 percentage point at the March meeting. And you can see since then, the probabilities have declined. And correspondingly, the probabilities of staying at the current rate have risen. Go to the May meeting, you can see the same kind of trend. Basically, the market has lessened its probabilities over time of rate drops. Okay, so that's something that we expected probably would happen. We think the market got way too optimistic about rate cuts, and as a result, certain asset classes have sold off because we think they got ahead of themselves on these rate cut odds. Things like bonds have sold off pretty hard. We're glad to have lightened up that position. Precious metals have sold off a bit, and we're glad to have hedges there. And so a lot of uncertainties in the future here, but we think we're well prepared, and we have the tools to we think hopefully guide ourselves and really our clients I'm talking about here through whatever waters lay ahead. So that's it for today. We'll of course be back next week, and I want to thank you on behalf of our team for tuning in, watching, and thank you to our clients for your trust and confidence. Have a great day. Goodbye for now.